numbers?
Well, we've continued what we've been doing for the last several months, Sarah. So I think the basic contours of the portfolio, underweight duration, looking to emphasize cyclicals in the portfolio. Practically, what does that mean? More financials, more banks, both in the U.S. and Europe, higher weight to industrials, to materials. We have trimmed tech. It has been a funding source. We haven't purged it. We still like a lot of those names long term, but I think consistent with a lot of what we've been talking about the last few weeks, we have been tilting the portfolio in a direction which is more consistent with the type of growth we're likely to see over the next few quarters and, frankly, the type of inflation we're likely to see.
Does that mean that I was going to ask, shifting out of tech is one thing, but cyclicals look attractive in that light when you think it through, but have they also overrun themselves a little bit in the short term?
I think it depends. I do think you still want to lean into the cyclical trade, particularly some of the banks, the material stocks. But here's the interesting thing. Having cyclicals doesn't necessarily mean deep value. It certainly doesn't mean some of the high beta names. One thing that's been interesting, and I don't think remarked on very much, is if you look at the higher beta parts of that space, whether it's small cap, some of the lower quality names, they've actually been underperforming. I think this goes to an important qualification. Cyclicals, yes. Junk, no. What we've been trying to emphasize are those parts of the cyclical space that have superior cash flow generation. So that's where, in my opinion, you're going to see the best performance, and also the stocks that offer some downside protection in weeks such as this.
What sort of exposure do you have to technology right now, Russ, and within tech? What kind of groups, what kind of sectors?
Sure. So we have brought our technology exposure down. If we look at it in a broad space, we're still, a little bit overweight. There are a lot of parts of technology that are cyclical. And I think this is something that, again, sometimes gets lost. Semiconductors, payment companies. We're finding that there are opportunities to both leverage those secular themes, but also take advantage to names that are going to be geared to what we expect will be some pretty strong growth over the next few quarters. Particularly from the consumer. I mean, we've never seen U.S. households in this good of shape. 25% savings rate. The unemployment rate is coming down very fast. We're seeing strong growth in personal income thanks to the stimulus. Part of what we want to do in the portfolio, and actually consumer discretionary is our largest overweight, is geared to those types of themes.
Just quickly, Russ, to round things off, your notes say you're dumping out of gold. Is that right?
We've been aggressively lowering our gold exposure. We've gone from probably about 4.5%, 5% a year ago down to well less than 1%. And the reason for that is very simple. You've got a world where you're expecting phenomenal growth, and the real yield on the U.S. 10-year is still about negative 80, negative 90 basis points. It's very hard to reconcile. If real yields normalize, which is what we expect, not a great time to own a lot of gold.
Shepard Smith here. Thanks for watching CNBC on YouTube.